Well, it's a possibility, it's a risk, and the report is about risks. And indeed, since last year, we see this perception that the world economy, particularly in the US, but also in Europe, is going into a recovery, which is firming itself. It's more self-sustained. And that, of course, by itself can contribute to a change in the perception of markets in the direction of higher bond yields going forward.
The thing is, when I saw the report this morning or an hour ago, I thought things seem to have gotten a lot better, and maybe it just took you a while to put the report together. I mean, a lot of the uncertainty issues seem to have solved themselves.
Well, the report is not a description of the present situation. The report is about future risks in the horizon of 18 to 24 months, as we explained. And in that perspective, the continuation of the recovery, which is now spread all over the world in a synchronized way, can indeed lead to the continuation of increase in bond yields, which is, of course, a reduction in bond prices, entailing potential capital losses for holders of those bonds. And this is in itself a risk. And that's what we point as a potential risk. We are not saying, analyzing all those risks, that they are going to materialize. It's not a forecast. It's an analysis of risks to see if they materialize, what would be the consequences, and the answers that would be needed. So that's the perspective of a financial stability review. And in that sense, this is certainly a risk because financial institutions are big holders of fixed income instruments, and any change in their prices have material effects.
Well, one of the things that could bring up an abrupt change in those prices is your monetary policy. I know you like to keep the financial stability report separate from your monetary policy decisions, but clearly they're linked here because a concern that your monetary policy would be normalized quicker than expected is one of the things that could boost interest rates.
Well, I think that markets have understood very well our reaction function in what regards our monetary policy. So I do not fear that markets would be in a position where they would be surprised by what we will do in the future, reflecting the new situation, the new developments. Markets know that we are committed to a certain policy stance until the end of this year, which by definition means that we have to communicate something to the markets before the end of the year, closer to the end of the year. Markets understand that very well. And so I do not fear any problems or turbulence resulting from our monetary policy decisions going forward. As you said, financial stability is always implicit in the concerns of central banks, since there are central banks, but we see the financial stability risks as something that has to be addressed by macroprudential policies, meaning changes, decisions about regulation and supervision of financial institutions.
Do you have to be especially cautious at this June? I mean, if you want to make it clear that there's going to be some change in monetary policy by the end of the year, that leaves out June, and it would make sense to be cautious this June because you've got the Fed moving again in June.
I'm not anticipating what the Governing Council will do in June or in September. I'm just pointing out to something that is evident, that we are committed explicitly with certain policy instruments until the end of the year, and we have to take decisions then about the future before the end of the year. In my perspective, closer to the end of the year, but that's not in the end an important consideration if it is just a problem of analyzing what would be the best time to do it. That's not, in the end, so important.
Would you like to first finish bringing policy back to normal as far as things like quantitative easing before you start to raise borrowing costs?
Well, that's what we say in our forward guidance, and it's important for any central bank to continue to be credible in what regards implementing its own forward guidance. It's important for the future credibility of the central bank. So that's what it is indeed said, as you know, in our forward guidance.
Why would you do it that way if the Fed could do it the other way? I mean, why do you need to unwind your QE or stop QE before you start to raise interest rates?
Well, we decided that way when we disclosed our forward guidance because we saw that it was important to keep very cautious in what regards interest rates in order to be sure that we would reach a situation of sustained inflation close to 2%. And we are not yet there on a sustained basis because the more recent increases in headline inflation have resulted mostly from commodity price developments, and we don't see yet the domestic factors of inflation materializing to reassure us that we will be in a sustained path of inflation without the accommodative policy that we presently have. We see that the output gap is still negative. We see also a negative unemployment gap because these will be closed only perhaps by 2019. We see that the unemployment gap is too high and wage increases are still too low to reassure us about the sustainability of inflation at the level that our mandate requires.
Let me just ask, last year when I talked to you at this meeting, you said that in your personal view you thought that inflation in 2018 would be in line with the ECB targets. How far back have you pushed that now?
Well, I am not sure about what you just quoted because I am absolutely sure that last year I did not anticipate that inflation this year would be below but close to 2%, and it's not.
Next year, 2018.
Well, we have published our staff projections recently, and the numbers that are in those projections, I think, are very likely to materialize. If anything, perhaps if the situation continues to evolve in the same way as it has been the case recently, slightly above, but very slightly. That is something that we can rely on, but it's important to underline that those projections are predicated on the present monetary policy being very accommodative. So that's an important point, which again points to the caution that we have to change our policy at the moment when we will feel reassured that the drivers of inflation are sufficiently sustainable.
But sufficiently. You'd be willing to hold this accommodative policy with inflation over 2%?
Well, I do not anticipate such a situation, but we have to be assured indeed of the sustainability of the inflation level when we get there, and we have not yet done so.